folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. We thought we'd come to you with a little bit of a market update, let you know exactly what's going on out there. Currently, S&P 500 is about 4460. That's down about 9% for the year. So giving back a little bit of the gains that we saw in March, after obviously a very rocky start to the year. Minus 9%, we're closing in on correction territory. We've been flirting with that, all through the course of this year. We've actually had a correction, recovered back a little bit, and then gave a little bit of that back. So, once again, we always talk about, these are good times to find a level and just focus on that level as opposed to focusing on the daily percentage change, because you're going to drive yourself nuts trying to think about, are we up 1%, or are we down 1%, or up 1% or down 1%? Conversation in the market's largely focused on inflation and interest rates. The Ukraine has kind of occupied, has fallen a little bit out of the news cycle. Previously, we were using Ukraine to explain higher commodity prices, which were flowing into inflation rates, which were then flowing into interest rates. Now we're just sort of purely focused on inflation and interest rates, as it drives the market. And just so everyone understands that dynamic, the idea here is that higher interest rates lower valuations for all asset classes. If you think about loaning somebody $100 with the expectation that they're going to pay you back $105 a year from now, you've loaned them money at a 5% interest rate. If the day after you make the loan, interest rates go up to 7%, you think about that loan as a promise to receive $105 a year from now. That loan is now worth less than $100, right? You would pay less than $100 to buy that loan from your friend. And indeed, that works across equities and fixed income securities. As interest rates rise, valuations multiples go lower. And that's what we've seen the market really struggle with here in the first quarter and the beginning of the second quarter, is just this notion of, where are long-term interest rates going to settle out? The Fed came out earlier this week with their minutes from the March meeting, and those minutes are increasingly hawkish. It shows a Fed, concerned about inflation, concerned about getting inflation under control. And the primary tool that they have to do that is through interest rates and also shrinking the size of their balance sheet, and they've indicated a willingness to sort of use both. On the inflation front, I just want to remind everybody sort of how it's calculated and how it's talked about, so that we can get an idea of what's going to happen on a go-forward basis. When we talk about inflation, we talk about year-over-year changes in prices, which means that when we talk about running sort of 6, 7, 8% inflation today, what we mean is that prices are 6, 7, 8% higher than they were at this time last year. A lot happens in a year. If you think about where we were in April of 21, the economy was just reopening. A lot of you probably hadn't even been on planes yet. We were still under mask mandates. It feels like a long time ago, but 12 months is a long time. So it's not hard to understand why prices have gone up that much, because demand has spiked a whole lot and has really outstripped our ability to supply it. There's 2 points on that. The first is that as we anniversary, as we get further through the year, the comparison points change. So when we get to December and start to measure inflation, we will be measuring December of 22's prices against December of 21's prices, which means that in order for inflation rates to go lower, we don't necessarily need prices to, go down from where they currently are. We just need them to level off. And that's one of the real reasons why, when you look at forward projections for inflation, you sort of see the sort of 8% rates that we're running now, or more like 6% rates on the core, dropping to more like mid threes by the beginning of 2023. That's not a call that prices are going to start getting magically lower, but it's more a call that, we anniversary the spike in demand and get, what's known as an easier compare, which is a positive sign. The second thing that I would say is, we've seen a couple of folks now come out with, recessionary calls, recessions, 2 years away, 3 years away. You guys, if you've seen some of these market updates before, sort of how I feel about that. It's always nice to make the call on a recession happening 2 or 3 years away from now, because it's just long enough that if it doesn't happen 2 or 3 years out, you will have forgotten that the person called for it. But it's just close enough that people tend to panic and pay attention when you make that prediction. What is going on right now on the inflation interest rate side is a problem of too much demand relative to the amount of supply that industry can produce, basically. So we have too many people that want to buy too many things. They want to drive too many miles. They want to eat too many meals outside the house, this and that, relative to our ability to supply those things. And so the solution to that problem is to actually make people less interested in doing those things. The Fed is interested in demand destruction, which, if you think about it, is another interesting way of saying the Fed is interested in making us all a little bit less happy. And that's a good thing as far as prices are concerned. So, it is not the case where, we see an imminent, bout of demand destruction. In fact, demand destruction actually solves the problem. It doesn't create a new one. And so I would just sort of note that, I think that any type of recessionary call, certainly in the immediate predictable future, is a little far-fetched, at least in my opinion. Last but not least, we've seen a couple of folks comment on the shape of the yield curve. This is a commentary that came up, a couple of months ago. It feels like actually maybe a year ago, shape of the yield curve predicting a recession. I would just note that, this is one of the most manipulated yield curves in history in terms of the government being out there buying bonds at all different maturity points along the spectrum. It's very hard to treat that as a reliable indicator or as even the same indicator that it was back during the days when it used to be a very reliable predictor of recessionary behavior. 2008, the 2019 crisis were the first time that the Fed actually used its balance sheet to go out and buy long-term bonds. That, in my mind, distorts the ability of the yield curve to really say, okay, well, what is it telling us? Because it's probably not the same message that it was telling us back in the 80s or the 90s when the Fed wasn't using its balance sheet as aggressively. So, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.